Hello, everybody. Coming to you live from quarantine. This is chapter 14's lecture. It's it's not going to be too different than what we talked about in the last lecture. And when I say we, I mean me, because you guys, no one asked me questions in my video. It was very sad and lonely. Anyways, what we're going to talk about in chapter 14, you have the PowerPoint, you have the text. I'm going to do the main calculations on the Zoom video. I'm not going to go too much into detail on terms and stuff, but we're talking about issuing bonds, okay? That's at least what we're going to focus on. So when a company issues bonds, it means they tell the public, hey, we have 100,000 in quantity, $1,000 bonds available for you to buy. The public buys them. The company gets all this cash up front. Okay, this is called debt financing. So it's when a company wants cash immediately and they're trying to think of ways to get it. So they issue bonds. People buy the bonds, company gets cash now, and maybe in like 5 years, the company has to pay back all of their bondholders. Okay, so it's a way to get cash now, pay it back later. Maybe the company wants to make a big investment, buy a building right now, diversify into a new market, whatever they need cash for. Okay, now when a company issues bonds, for the large most part, I've never seen a bond without interest. They have to pay interest either annually, semi-annually, quarterly, however they want to set it up. But generally, bonds come with interest. Um, so they recognize interest being paid and interest expense throughout the life of the bond. So what we're going to learn today is really how do companies calculate issuing the bonds, paying the interest on them, and we're going to talk more about premiums and discounts. So we started that talk in chapter 13, which is why I said this isn't going to be too different, and we're going to keep with it today. So a company issues bonds for $1,200,000. 8% is their rate, semi-annual at face value. So you'll see very straightforward transactions just like this, where it says a bond was issued or bonds were issued for a total of some amount, in this case $1,200,000. 8%, since this has no other rate, 8% is the rate that is issued with the bond. That means the rate issued with the bond is the coupon rate, also called the stated rate. Okay, it's interchangeable. And again, it's the rate attached to the bonds. And the bonds are issued at face value. That means they're not issued at a discount and they're not issued at a premium. That's why there's only one interest rate here. Whenever bonds are issued at a discount or a premium, you'll have a market or an effective rate, okay? Interchangeable. It's called the market rate or effective rate. That is the average rate on the market that bonds are going for. That's what makes them be issued for discount or premium. For this starter example, it's just issued at face value, so there's only a coupon rate. And I said they're semi-annual bonds. So that means they pay interest every 6 months. Okay? So for all these examples, we're going to assume bonds are issued on January 1st, 2018. Okay? And we're going to say, for this very first one, it's pretty simple. Since they're issued at face value, we debit cash, 1,200,000, and we credit this long-term liability, bonds payable. Okay, so we are receiving $1,200,000 in cash, but we're saying we recognize we are liable to pay back this same amount of cash. Okay, I didn't put a time frame here. It doesn't matter right now. We'll say 10 years. So 10 years in the future, we will pay back this $1,200,000 value. Okay. Now, the bonds are semi-annual. That means semi-annually, we pay interest to those who bought our bonds. So we'll say June 30th rather than July 1st. 6 months, okay, roughly. June 30th, 2018, we have to pay interest. So our first interest payment. Okie dokie. So on this day, we're paying interest. what are some things you definitely need when you pay interest? Well, you need to recognize interest expense. It's an expense account, so you're going to debit it. And for this example, we're going to credit only cash, okay, because we're paying out cash. So whenever we pay our interest, for our purposes, we're going to credit cash, okay? So now what's the value? So this is just a simple interest calculation. 1,200,000 times the coupon rate, since they're issued at face value, so 8%, 0.08, times semi-annually. So semi-annually means twice a year. So you could do 6 over 12 for 6 months out of 12 months. Or if you simplify 6 over 12, 0.5. Look at that fancy stuff. Oh, why? There's no typo. Oh, I put a parentheses. So 1,200,000 times 8% times 0.5, $48,000. So that is the interest expense and the cash that the company has to pay every 6 months. Okay, so this is for a real easy bond issued at face value, no discount, no premium nonsense. Okay, good stuff. Any questions? No? No one? No one at all? Oh, horrible. Oh well. Discount bonds. So, bonds issued at a discount. I just want to make sure I set my stuff up. Oh man, I knew I did that. Okay. In 2 seconds. This would be the awkward time where I stare at my notes in class because I realize I might have messed up some of my figures that I'm about to present to you guys. Market. Okay. All right. Ignore this. You see nothing. Ignore the man behind the green curtain. So we're going to say, again, assume January 1st, we issue $1 million worth of bonds, 9% 5-year. Okay, so whenever you see a percentage right after what the bond's face value is, it's always some nice, neat round number because generally bonds are issued for $1,000. Okay, so what this means is we're issuing a total of $1 million worth of bonds. Generally, they're $1,000 each, so we're issuing 1,000 bonds. Okay, so we're issuing 1,000 bonds. They're totaling $1 million. 9% is the coupon rate. 5 years is their life, and they're annual bonds. So they're not semi-annual, they're annual. That means they pay interest yearly. And we're issuing them for $962,091.83 with a 10% effective rate. So that's the market rate. So this is why we're not issuing them at face value. When we looked at this first one over here, they were issued at face value because there was only one interest rate. But when there's multiple interest rates, they're issued at either a discount or premium. Okay? So in this case, we're actually issuing them for less than they're worth. Okay? The reason we're doing that is because customers who are buying bonds could get 10% interest out in the market, which is higher than what we are offering. So what we are saying is give us only $962,000 in cash right now, and we will give you back $1 million in 5 years. Okay? So since they're getting a kind of crappier interest rate than what they could get, we're giving them a discount on the bonds. Okay? So here's how this would look when you issue it on January 1st, 2018. Okay? I'm using 2018 again because life was so good back then. Now it's weird and strange, and I don't appreciate it. Anyways, January 1st, 2018, we're issuing bonds for $962,091. They're really worth $1 million. So we receive cash for what we are actually going to receive for the bonds, which is the $962.91. So $962,091, $91.83. I'm not good at it. I'm only an accountant. Dollar. Okay. We're going to credit. Look, I'm going to leave a line here because I know they're a discount. Whenever there's a discount, you're going to debit discount on bonds payable. Okay, but I'm not going to fill in the value yet. Okay, so discount on bonds payable, and we're going to credit bonds payable. So bonds payable, again, just like in this first one, it's the long-term liability. We credit bonds payable for what its face value is. Okay, so that's the value that's actually attached to the bonds. So $1 million in this case. Now the discount, when the face value of the bonds is greater than what we're actually issuing them for and what we're actually receiving, that's the discount. It's the difference. So 1 million minus 962,000, etc. So the discount's $37,908.17. This discount is a contra liability account, really, that takes away from the value of bonds payable on the balance sheet. So you would see bonds payable, 1 million, and then you would see below it discount on bonds payable, 37,908. When you clash them together, you would get this value, $962,091.83. Okay. Now, whenever you have a discount or a premium on bonds, you have to amortize them. Amortization is reducing the discount or the premium until, God, I hate when emails come up, until they reach zero. Okay? Because what we're doing is this reduces the book value. So bonds payable minus the total discount brings the book value to 962. Over the life of the bonds, we want to bring the actual book value up to the face value. We want them to equal. That's the point of amortization. Now, when it comes to amortization, though, we have two methods. Straight line amortization, as you can imagine, is nice, pretty, and easy, just like straight line depreciation. And then we have an effective rate. An effective rate is what you saw in the last video where we made this nice, beautiful table. Okay? So, straight line amortization is literally the discount on bonds payable divided by the life. So in this case, the discount on bonds payable is 37,908.17 divided by 5 years. And I'm going to backtrack quick. I said life. I should have said this. Number of interest payments. Okay? So discount on bonds payable, the value divided by the number of times interest is going to be paid. Number of interest payments we have to make. The reason that's important is if this was a semi-annual bond, we would amortize it twice a year for 5 years. So in that case, if this was semi-annual, the formula would be 37,908.17 divided by 10. That's twice a year for 5 years. So we would amortize it 10 times this value. Okay? So we would amortize it $3,790 every time we paid interest. But in this case, it's only an annual bond. So we're only going to pay interest once a year. So we only amortize it once a year. That's why we took the value divided by 5 only, because it's an annual bond. So when we get to our first interest payment, and we're going to make it, I'll make it January 1st, 2019. Don't worry about accruals or anything like that, interest payable. We're going to hit the bare bones stuff. So 1 year passes by, we have to pay interest. So we're going to debit interest expense. That's going to be one of our accounts. We're going to credit cash, okay, because we're going to pay cash out. And we're going to credit, what are we amortizing? We're amortizing discount on bonds payable. So we're going to credit this account. Our goal is to reduce this number to 0 by the time the bonds are ready to be paid back. Okay? So discount on bonds payable is this figure, what we calculated. Under the straight line method, think of straight line depreciation. Straight line depreciation never changes year to year. The formula, you do it at first and nothing changes. Discount on bonds payable, they will never change because we're using straight line, okay? We're doing it evenly, the same amount every time we pay interest. Cash is going to be credited for the interest we have to pay. The interest we have to pay is $1 million total times 9%. So $1 million times 9%. If you remember on the first page, the bond issuance page, the real easy practice one, we did times 0.5 for semi-annual, okay? Because that's the simplified version of 6 months out of 12 months. However, in this case, it's a year, so it's 12 months out of 12 months. So that simplifies to 1. So theoretically, if you wanted, you could do times 1. There's no point in doing that. Excuse me. So the cash paid is $90,000. Okay, so that is how the cash will be found. The face value, $1 million, the value that's assigned to the bonds, times the coupon rate. Okay, interest expense is then the combined amount of the cash and the discount being amortized. So in this case, interest expense is $97,581.63. So under the straight line method, nothing will ever change about this journal entry. So on January 1st, 2020, wow, remember that? We thought life was so good then. Interest expense is debited, cash is credited, discount on bonds payable is credited, and it's all for the same amount. So once you do it once under this method, it doesn't change, which is nice. And you would do this for all 5 years. Okay? So again, we are slowly reducing discount on bonds payable to 0. If I made a real quick T-chart, I'll try to make this the only one I do. Discount on BP. Matter if I sang to you guys as I stuttered my way through this. We would debit the account $37,908.17 for initially, and then for 5 years we're going to credit it $75,881.63. So year 2, year 3, year 4, year 5. So after 5 years, rounding taken into account, we should be off maybe like a penny to 5 cents. The updated value in this account, let's see how good my Excel is, should be close to 0, 2 cents. Okay, that's what I said, rounding. So again, after the 5 full years of doing this journal entry, it's down to 0. Okay. Then what happens when we're all done with this bond, 5 years from 2018, so January 1st, 2023, after we made our last interest payment, to take the bonds payable off our books, because now we're paying back this full value. So this is what a discount bond is. We receive a discounted amount of cash because we're giving them a crappy interest rate. Then at the end of the bond's life, we pay them back the full value of the bond. Okay, so we're going to debit bonds payable, $1 million, and we're going to credit cash, $1 million. All right. Oh man, I didn't even count the zeros. I just followed my heart and I was right. All right, so that's a discount on bonds payable. Now we're going to look at the effective rate. Okay, I'm going to delete all this. So the effective rate is where you have that nice amortization schedule. Okay, straight line, even amount every year. The effective rate says, hey, you actually recognize a different amount of interest expense as the book value changes of the bond. So up here, we're dealing with all the same figures. We're issuing $1 million worth of bonds that come with a 9% coupon stated rate. They're for 5 years, they're annual, but since our interest rate's 9%, on the market you could get 10%. We're going to issue them at a discount, $962,091.83. We have to amortize this. So the initial journal entry is the same as it was on the straight line. We would debit cash, debit discount on bonds payable, credit bonds payable, all for this value. So this is all the same. Okay? When it comes to amortizing, though, we're not going to just take the discount and divide it by 5, because that's straight line. We're doing the effective rate. Okay? So what we do is we have to set up this amortization schedule. When you set one up, best thing to do is to make a column for the date, and you start with the date you bought the bond. So again, we're assuming everything's January 1st, 2018. You make a column for cash, make a column for interest expense, make a column for the discount, then make a column for the book value. It's also called the carrying value sometimes. I think in my last video I called it the carrying value. They're interchangeable. And the carrying value is basically the face value minus the total discount. So in this case, on January 1st, 2018, the book value is the cash we received, $962,091.83. Okay. So how do you do the effective rate? We're still dealing with 5 years. So once every year when we pay interest, we amortize the discount. Okay. So I would actually change this to we word it as amortized discount. This is going to be the amount that we amortize the discount every time we pay interest. So let's jump ahead to January 1st, 2019, the first time we pay interest. The cash we're going to pay out is calculated the same as it was under the straight line method. The 1 million face value times the coupon rate, 9%. Again, it's annually, so it's for 12 out of 12 months, which would simplify to 1, or we could just leave it as $1 million times 9%. So 90,000 is the cash. The interest expense under this method, we do calculate. So in the straight line method, we basically filled in the blank in the journal entry. We calculated cash, we calculated the yearly straight line amortization, and then we combined them to get interest expense. Under the effective interest method, we calculate the interest expense by taking the previous book value, so the most previous book value, multiplied by the effective rate, so 10%, and then multiplied by the term. Again, if it was semi-annual, it would be 6 over 12 or 0.5. In this case, it's annual, so it's 12 over 12 or 1. Okay, let me make these all dollars. Dollar, 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 dollar. All right. So we calculate the interest expense, we calculate the cash. Amortized discount, this is the one we fill in the blank. Amortized discount is the difference between the interest expense and the cash. So in this case, $6,209.18. And now the book value changes. So when you have a discount, you add the amortized discount to the previous year's book value. Our goal is, again, to bring the book value up to the face value. So after 5 years, if we do this right, something tells me something's off. But if we do this right, at the end of 5 years, so $2020, the book value should equal very close to $1 million. Okay, by doing this math. Okay. Now, look at the formula for cash. Cash is calculated by taking the face value by the coupon. These never change. So cash is never going to change. It's going to be 90,000 every time we have to pay money. Real quick, before we go on, let me make just one journal entry for this first interest. So interest expense is an expense. We're going to debit it. We're going to credit cash because that's what we're paying out. And we're going to credit the discount on bonds payable. Sorry, capitals, some are caps, some are not. I just type weird. So interest expense, we're going to debit it for what we calculated in the table. Cash, we're going to credit for the 90,000. That will never change. And the amortized discount, we're going to credit for the 6209.18. Okay? So this is, you always debit interest expense, you always credit cash, you always credit discount on bonds payable. It's just the values that will change under this method. And here's why they're going to change. Cash will stay the same. Interest expense is calculated, again, by taking the most previous book value. In this case, the book value changes every year because we add this current period amortized discount to the book value. So we're going to take 968,301. We're going to multiply it by the effective rate of 10%. It's a yearly bond, so that's all we have to do. And now the amortized discount, what are you doing? Why did you do that? The amortized discount is, again, the difference between interest expense minus cash, 6830, which is going to change the book value, the previous 968 plus 6830. So the book value is now 975,131. So when we make our second year journal entry, interest expense would be debited for 96,830 now, 10 cents. Cash would stay the same, and the amortized discount would change to be 6830.10. Now, if we go ahead and we fill this out, again, the new interest expense is going to be this book value, 975 times 0.10. Amortized discounts, the difference between these two in the new book value, add it up. And if we continue to do this all the way down, we should get very close, off by like a penny to 5 cents. All right, 50 cents in this one, a bigger difference, but again, we're close. As long as you see all those nines, you're very close, rounding wise. So very close to $1 million. Okay. So that's discount bonds with the effective rate. The journal entry setup does not change. It's just dollar amount. Okay. And it's just a different way to recognize interest expense. Okay. What GAAP says is you should recognize less interest expense early on because of the book value of the bonds. And then as the book value grows, you recognize more interest expense. Okay. Now we're going to move a little faster. We're going to go to premium bonds. So premium bonds are this. It's when, I missed something here. What did I leave off? All right, the effective rate's 10%. So premium bonds are when you're offering a better rate than your competitors. So you're offering, in this case, 12% interest on your bonds. In the market, customers can only get 10% interest on the bond. So they're going to receive more interest if they go with you. But to make it worth your while, since you're paying more interest than everyone else, you offer your bonds for a premium. So you offer them for a greater amount than what they're actually worth. Okay? So when you offer bonds for a premium, you debit cash for the amount you're going to receive. In this case, the bonds are worth $100,000, but we're issuing them for $103,545.91. Okay. We credit bonds payable. Bonds payable will always, no matter what you have, be credited for the face value of the bonds. In this case, it's $100,000. when you receive cash greater than the bonds payable, when your interest rate, the coupon rate, the stated rate is greater than the market rate, and you have a premium, so you're receiving more than the worth, you credit, instead of discount on bonds payable, premium on bonds payable. It's basically the inverse contra liability account, and you credit it for the difference. So 103,545 minus 100,000, we're going to credit it for $3,545.91. Excuse me. Okay. So this, you still pay interest on these. At the end of the life of the bonds, you're going to pay your customers back who bought the bonds $100,000 worth of cash. You got to pay interest throughout the life. So we said these are 2-year bonds, semi-annual. Okay, I kept it nice and short. Praise me. And we're going to do the straight line method. So this is actually good. So the straight line method of amortization, again, the point is to bring the carrying value, which is now in this case, the value of the bonds plus the premium. Okay, discounts take away, premiums add to it. So the carrying value of the bonds right now is $103,545. Our goal throughout the life of the bond is to bring this value down to the $100,000 bond payable. Okay. Under the straight line method, again, it's nice and simple. You take this premium figure divided by the number of interest payments we're going to make. So if this is a 2-year bond, but we're going to make an interest payment twice a year, 2 years times 2 interest payments a year is 4. I feel like I'm doing first grade math with my son. This is what we do for an hour every day at 9 to 10 a.m. My life is great. Anyways, so this is the straight line amortized premium amortization. Okay. So now look, let me ask you this. With our prior journal entries, we had a credit discount on bonds payable every time we paid interest because we initially debited it. So we had to reduce this big number to 0. To do that, we had to credit it. However, premiums are initially credited. So if we want to reduce those to 0, we have to debit the premium on bonds payable. And we're going to debit it each time by the $886.48. Okay. Cash is also going to be, I said cash, I almost said cash was going to be credited. Cash is going to be credited. I almost said cash is going to be debited. Cash will be credited the same way we've been calculating cash. The face value of the bonds, $100,000, times their stated rate, the coupon rate, 12%. Now times the term. We were doing annual, but now since it's semi-annual, it's for 6 out of 12 months or 0.5. So in this case, cash is going to be credited for $6,000. That won't change. So what are we missing? We're missing one debit, and that is to interest expense. And to calculate interest expense, when we have a premium on bonds payable and we're doing straight line amortization, it's just the difference between the cash and the amortized straight line premium amount. So interest expense will be $5,113.52. Okay. So if we did this journal entry up here on January 1st, 2018, this one down here would be for January 1st, 2019. We'd go down January 1st, 2020, and it would be, guess what? The same exact entry, because the straight line method is nice and polite, and we like it. Okay, and we would do that for all 2 years. Okay, my apologies. So this is semi-annual. So if we initially did this January 1st, 2018, this would happen on July 1st, 2018, and then the second payment would happen on January 1st, 2019. Okay. Then the third payment would be July 1st, 2019. Same journal entry. And then the fourth payment would be January 1st, 2020. Same entry. I just hit Control V. Okay. So again, because they're semi-annual and they're only for 2 years. All right. Now on to the effective rate method. Okay, as you can imagine, based on the discount method, this part has a bit more work because we got to build a table. Okay, and what I'm going to do is I'm going to be lazy and I'm going to copy the headers from my table. So we're dealing with the same bond. Issued a bond for $100,000. Issued bonds, I should say, valued at $100,000 for 103, 545, 91. They have a stated rate of 12%. They're 2-year bonds paying interest semi-annually with a 10% yield. So the market rate is 10%. So on January 1st, 2018, sorry guys, noise. January 1st, 2018, the book value. Now again, when it comes to premium bonds, so I should put this book value under discount bonds is equal to the face value minus total, or I should say current discount on bond payable value. The book value under premium bonds equals the face value plus current premium on bond payable value. Okay. So in this case, the book value is the face value, 100,000, plus that $3,000 premium. So the book value is, for the first time, the cash we're going to receive. Okay, let me make everything money. Money, money, money. So again, it's the same thing. Even though we're going to do the effective rate, the initial journal entry is still going to be this. Now, with the effective rate, we're dealing semi-annually. So we're going to have July 1st, 2018. We're going to have January 1st, 2019. We're going to have July 1st, 2019. And then we're going to have January 1st, 2020. This is 2 years from the original date. Okay. Our goal at the end of these 2 years is to bring this value, the book value, bring it down to very close to $100,000. And again, it's going to be off just because of rounding. So, how do we tackle it? Cash is tackled the same way. So July 1st comes, we have to pay interest. Cash is going to be the face value, 100,000, times the coupon rate, so 12%, times the term, so 6 out of 12 months, or 0.5, half the year. Why do I do this? Why do I do this? So $6,000. Okay, that doesn't change. Interest expense, we are going to calculate since we're doing the effective rate. Under the effective rate, we calculate the interest by taking the previous book value, or the most up-to-date book value, multiplied by the market rate, 10%, multiplied by the term. Again, it's semi-annual, 6 out of 12 months, or 0.5. So the interest expense, $5,177.30. Now the amortized discount is actually the amortized premium because we're dealing with premiums. Amortized premium instead of interest expense minus cash, which is what it was for the discount bonds, it's cash minus interest expense. So for July 1st, the amortized premium is $822.70. So if we journalize that over here, July 1st, 2018, we're going to debit interest expense, $5,177.30. We debit the premium on bonds payable because, again, we initially credited it for this amount, and now we want to reduce this value to zero. So since it was credited, we're going to slowly chip away at it by debiting premium on bonds payable, BP, $822.70, and then we're going to credit cash, $6,000. Okay. So now with premiums, the new book value is the old book value minus the amortized premium. Because again, we're bringing the book value down to $100,000. Okay. So cash will never change because think about the formula. It's based on the face value, 100,000 times the stated coupon rate, 12%. Interest rate will change because it's based on the most updated book value times the market rate, 10%, times the period, so 0.5, 6 out of 12 months. What did I do wrong? Yeah, what did I do wrong? The book value? Oh, I did minus 0.1. So times 10% times half a year. The amortized premium is, again, the difference between the cash and the interest expense. And then the book value will be updated, take away the amortized premium. So if we keep going through, we should get a perfect 5 cents away from $100,000. So again, with the effective rate for premiums, they say you pay a little more interest up. You recognize more interest expense early on, and then as the value, the book value of the bonds fall, you recognize less interest expense. Okay? So what GAAP says is you're basically matching higher interest expense with the higher value of the bond, which makes sense. Remember, GAAP wants you to recognize things accurately based on when they are earned or incurred. Okay. So that's it. Again, a run through of the highlights of chapter 14. This is the big stuff that I want you guys to really know. You could read through the little stuff. There will be some questions on terms that you could just easily get from the book. But any questions, ask me, right? All right, I'm going to save this. I'm going to upload it with the video for you all. Over now.